You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
Jim, thanks for coming on to the Big Trade series. It's been actually a long process trying to get you on. I know you've been discussing a lot about your book, but thanks for finally coming on the Big Trade series.
Glad to be with you, Peter. Thanks for inviting me.
So I've noticed in terms of some of your works, there seems to be some kind of chronological component to it. We've seen books like The Currency Wars, The Death of Money, and now A New Case for Gold. Is there some kind of like evolutionary process that has happened in terms of some of the works that you've released recently?
Well, what I would say, Peter, is that, of course, all the books are different, but if you're saying is there a thread that connects them, I would say yes, absolutely. And it goes back to my first book, Currency Wars. I said two things. Number one, the world is not always in a currency war, but when they are, they can go on for a very long time. The book had a history of two prior currency wars, what I call Currency War One, which lasted from Currency War One, which lasted from 1921 to 1936, and Currency War Two, which lasted from 1967 to 1987. So one went on for 15 years, the other went on for 20 years. What I call Currency War 3 started in 2010. So given that history, it wouldn't surprise me to see this currency war go on until 2020 or 2025, maybe even longer. So we sit here today in 2016, and you'll see journalists and commentators say, they'll point to some development in the foreign exchange markets, and they'll say, oh, there's a currency war going on. And I say, well, it's not a new currency war, it's the same currency war. It's the same currency war that's been going on since 2010. So I'm not at all surprised that this is going on. So that was sort of the first book as to the history and looking forward. The other thing I said in that book was that you cannot focus exclusively on deflation or inflation. You certainly have a lot of what I call deflationistas, people who are worried about deflation. And I would say Harry Dent and Gary Schilling are in that camp. There's certainly a lot of inflationistas, people who see inflation right around the corner, and maybe that's everyone from Peter Schiff to Janet Yellen on certain days. The point I'm making is that there are very powerful deflationary forces in play, having to do with debt, deleveraging, demographics, and technology. But there are also very powerful inflationary forces having to do with money printing, negative interest rates, currency wars, quantitative easing, etc. And that the proper analysis is that deflation and inflation are offsetting each other in a very unstable equilibrium. I'm not sure equilibrium is the right word, but certainly these are more like tectonic plates pushing against each other, and we're just waiting for an earthquake. Of course, we've seen a series of very severe and sadly tragic earthquakes from Japan and Ecuador just in recent days. But my point being, you can't get on one side of that or the other. You have to understand they're offsetting each other. So those are the two big ideas in currency wars. Number one, we're in a currency war and it lasts for a long time. Number two, there's an unstable tension, what I call a tug of war between inflation and deflation. So then in The Death of Money, my second book, I update the story, but bring in a lot more discussion of gold and how, because of the inconclusive nature and the potentially unstable nature of currency wars, gold could come to the fore, along with possibly the International Monetary Fund, World Money Fund, special drawing rights, or SDRs. And of course, in the gold book, my book, The New Case for Gold, which was just released last week, I look back at the first two books, Currency Wars and Death of Money, and say, well, in each one I talked about gold, one chapter in Currency Wars, two chapters in The Death of Money. I just want to sit down and take everything I know, everything I've learned about gold, my research on gold, put it all in one place, make it very accessible for the reader, and say here, gold's going to be an important part of the system going forward because of all these other problems. Here's what you need to understand about gold. So that was really the purpose of the book. It's shorter than the other two books, a little easier to read, a little bit of a manifesto, but hopefully a very useful sort of, not just primer on gold, but also an explanation as to why gold is back, why it's a very important part of the global financial system, and why we may see something like a gold standard with gold at $10,000 an ounce or higher in the near future. So that's the purpose of the book, and I hope the readers enjoy it.
Yeah, so in terms of the new case of gold, you discuss about the actual potential that gold could be used as a reserve currency for a particular country. I've seen you discuss about how it could be utilized in in the form of open market operations as well. And you also discuss a lot about how it would have to be worth quite a bit for countries to take it quite seriously to be used as a reserve currency. Maybe we could dive into some of that a little bit as well.
Sure. Well, of course, the dollar is still the dominant global reserve currency. It makes up about 60% of global reserves and closer to 80% of global payments. So there's no question about the dollar status, at least in the short run. But my focus is, where is the system going and what will the role of the dollar be in the future? So what I do, Peter, is look at the instability in the global monetary system. And I make the point that the global monetary system actually has collapsed 3 times in the past 100 years. So when I talk about collapse in the future, a lot of people roll their eyes and say, oh, well, that would never happen, or you're being alarmist, or you're doom and gloomer, what are you talking about, etc. And I make the point that, no, this has happened 3 times in the past 100 years, 1914, 1939, 1971. It does happen with some frequency. Shelf life for the global monetary system seems to be, about 30 to 40 years. The Louvre Accord in 1987 was the last time that there was at least a publicly acknowledged effort to write what they call the rules of the game, and that was just about 30 years ago. So I'm not saying the system's going to collapse tomorrow. What I'm saying is, no one should be surprised if it does, and if it does, what happens next? So I try to take readers through the collapse. Okay, here's the collapse. Here's what happens next, and then come all the way back to the present day and say, what can you, as an investor, do to your portfolio today to prepare for what we see coming? And that is not necessarily automatically a gold standard, although it could be, but it'll be one of 2 things. Either they will try to bail out the system with special drawing rights, that's IMF real money that the IMF prevents, which would be highly inflationary, which would mean higher price for gold, or they could go back to something like a gold standard. But if you do that, and I point this out in the book, it's critical to get the price right. If you go to a gold standard at today's price of approximately $1,240 an ounce, that would be extremely deflationary. You'd have to cut money supplies to maintain that parity. And so to do it all, you'd have to basically take into account the amount of physical gold or official gold, the amount of money supply, and it's fairly straightforward math. And doing those calculations, assuming 40% backing with combined M1 as your monetary base, that number is $10,000 an ounce. Now, when I say $10,000 an ounce, it's not a made-up number. It's not a number that I picked to get headlines or be alarmist. It's actually the number you'd have to use to avoid deflation. So either gold's going to go up because of inflation on SDRs, or gold's going to go up because you have to peg it there to make a gold standard work. But one way or the other, this is the future of gold.
Right. So I know you also talk a lot about the relationship between the Fed and the Treasury in terms of the certificates that they have for gold. It's quite interesting because there's many people that argue that the Fed is insolvent, but I know that you make a strong case that if you were to, look at mark-to-market for their balance sheet, if you looked at the gold exposure, that it could be worth a lot more and that the leverage would be reduced quite a bit. I think 13 to 1 is what you cite. Perhaps you could give the audience a little bit of a history about that with our 8,000 tons of gold within the Treasury. Is that held in Fort Knox, by the way?
Part of it's held in Fort Knox. A little more than half is in Fort Knox. A lot of it's at West Point.
Okay.
Some of it's at the Denver Mint, and a little tiny piece of it's in the Federal Reserve Bank of New York. But most of the gold of the Federal Reserve Bank of New York does not belong to the United States. There's about 6,000 tons at the Federal Reserve Bank of New York, but only a tiny portion of that belongs to the U.S. Treasury. The rest belongs to other foreign countries, the IMF. But the U.S. gold, the 8,000 tons of U.S. gold, that's divided among Fort Knox, West Point, and the Denver Mint, and again, a little tiny piece at the Federal Reserve Bank of New York. So that gold is owned by the Treasury, but you have to say, well, how did the Treasury get it?
Right.
The gold, if you go all the way back to 1913, the gold was, before 1913 was the year the Federal Reserve was created, that gold was in private hands, and a lot of it, not all of it, was kept in banks. So you put your gold in the bank, or you had your gold in a bank vault. Some gold was in circulation. People actually walked around with gold coins in their pockets, and you can use them. It was legal tender, and you could use it as a form of currency. Beginning in 1913, the Federal Reserve required its private member banks to buy their stock in the Federal Reserve. The Federal Reserve, of course, is privately owned, but you had to buy your stock in part using the gold. So the Federal Reserve required the banks to concentrate their gold in the Federal Reserve. So step one is the gold moves from private bank hands to the Federal Reserve. Step two, in 1934, the Treasury confiscated the gold from the Fed. But here's the point. The Treasury is the U.S. government. The Federal Reserve is a private bank. Under the Fifth Amendment of the U.S. Constitution, it is unconstitutional to seize private property without compensation. So what was the compensation that Treasury gave the Fed in exchange for taking the gold? The answer was these gold certificates you referred to. Now, those gold certificates to this day are still on the Fed's balance sheet. The Fed's balance sheet is a public record. You can just go to the Board of Governors Federal Reserve website and find a few clicks. It's there. It's not a secret. But what I discovered in doing my research, I started with the notion that if you took the Fed's bond portfolio and marked it to market, Fed might occasionally be insolvent. The balance sheet, the way it appears, is extremely highly leveraged. It's about 113 to 1. The asset side is heavily loaded up with longer dated U.S. Treasury notes, 5-year notes, 10-year notes, 7-year notes, 7 years to maturity, etc., which are very volatile. And the Fed has a tiny sliver of capital. As I mentioned, the capital base, about $45 billion, is less than 1% of the total assets. And so what that means is that if the bonds went down on a mark-to-market basis as little as 1 or 2%, it would wipe out the Fed's capital and make the Fed technically insolvent on a mark-to-market basis. By the way, I should be clear, Peter, that the Fed doesn't actually mark its balance sheet to market. The Fed holds the assets at historic cost. So this is not something that would ever appear on the Fed's balance sheet. But I'm just saying, if you treated it like a hedge fund or a bank and market it to market, they would be insolvent on if you market bond portfolio to market on occasion, not all the time, but on specific occasions, particularly when interest rates were going up. Now, I got a lot of pushback on this from a very senior, very plugged-in Fed insider. Is a friend of mine. He was disagreeing with me, but he wouldn't tell me what was the secret sauce. He insisted. He said that the Fed has never been insolvent on a mark-to-market basis. It's right there on the balance sheet. Go look at it. You'll see. But he sort of was a little bit of a game. He wouldn't tell me where it was. So I went back to the Fed balance sheet, and lo and behold, there was the hidden asset. It was the gold certificate, which was valued at $42 an ounce. But if you divide the book value of that by $42 an ounce, take the number of ounces, convert it to tons, lo and behold, you get 8,000 tons, which is exactly the amount, approximately, almost exactly the amount that the Treasury holds. So it looks like the Treasury gold is locked in to support a corresponding amount on the Fed's balance sheet. Furthermore, if you market the gold to market, you would add over $300 billion to the Fed's capital base, and they're actually leveraged on a mark-to-market basis if you count the gold and the bonds at a very reasonable 13 to 1, which is the normal leverage ratio for a commercial bank. So putting all this together, the good news was I got a little bit of comfort that the Fed was not over-leveraged because they had all the gold, but I was struck by the fact that it took the gold to make the Fed solvent. In other words, we're still on a shadow gold standard. It's just that people don't realize it and central bankers don't want to talk about it.
Yeah. So let's talk about another currency war, a gold war between China and the United States. We know that China has at least like several thousand tons of gold, and I know that they're trying to become at least comparable to what the United States has, and you can hear about that information in terms of the export figures of Hong Kong to China. But I know that you've had a conversation with Dr. Yu Min, right, at the IMF, and he's given you some perspective on that in terms of your research for the book. Could you share that to the audience and just give us some context of what's going on between China and the United States in terms of gold accumulation?
Sure. Dr. Yu Min is a very prominent economist and a central bank official, and he's had two interesting jobs. He was deputy governor of the People's Bank of China, which of course is the central bank of Communist China, and he's also deputy managing director of the IMF, making him, he reports directly to Christine Lagarde, making him one of the 2 or 3 highest ranking officials at the IMF, which is a very westernized institution. So here's a guy who has had, a top job at the Communist Central Bank and a top job at a Western-controlled, in effect, central bank of the world. So about the most plugged-in guy you could find. And I had a conversation with him, private conversation, and I sort of teased him a little bit because China was buying thousands of tons of gold, and the IMF was selling at least hundreds of tons of gold to meet that demand. And I said, Zhu, I said, who's on the right side of the trade? I said, you're a seller, China's a buyer. I said, somebody's wrong. And he kind of, he was a little bit nonplussed by that. What he said was that, well, China has to rebalance its reserves away from credit. Mm-hmm. And I thought that was a fascinating statement, because by credit, of course, you know, Treasury notes, which is a form of debt from the Treasury's perspective, and in favor of hard assets. And he actually used the phrase real assets. He didn't say hard assets. He said real assets. And I thought to myself, well, gee, this is extraordinary to hear a senior IMF official and former central banker referring to gold as a real asset, which I completely agree with, referring to Treasury notes as a credited asset. Of course, credit is just the flip side of debt, meaning debt. So what was very apparent is that this was all a rigged game, that China needed the gold. The IMF was willing to sell some. Not all. This is a reference to 400 tons of gold that the IMF sold in 2010. About half that gold went to India, Mauritius, and Sri Lanka. We know about that, but we don't know where the other 200 tons went. My assumption is it went to China. I can't prove that, but I think that's a reasonable assumption based on everything we know. The point is, the IMF is selling into the market to accommodate demand, and the demand was coming from China, and the IMF was looking at this in a very benign way as well. You know, you guys really need to reduce your dependence on Treasury paper and increase your allocation to gold. My point is, if the most powerful, plugged-in, smartest people in the world are rebalancing in favor of gold, why don't individuals do the same thing? Why don't institutions do the same thing? What are they missing? Well, what they're missing is what the Chinese see, which is the coming collapse of the international monetary system and dollar inflation. And if you can't temper treasuries, which China cannot, the next best thing is to own gold. That way, if inflation comes and the treasuries go down, the gold will go up. You'll have a balanced portfolio. So I would recommend that institutions and individuals have physical gold in their portfolios for exactly the same reason.
Thank you, Jim. Perhaps we can talk about some more stuff going forward in the future.
It's been great talking to you. Really, thank you for having me on, and look forward to our next interview. I hope so.
Thank you.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.